and welcome to this week's look at some of the major news stories that have affected the market so far. And what are we going to talk about this week? Well, we can't really not talk about the FTSE and the run that's been having recently. So we're going to take a look at the UK 100. And follow that up, we'll take a look at what the dollar did in response to the FOMC meeting, two-day meeting this week, and particularly have a look at how it's been faring against the Great British Pound. Thirdly, we're going to stick with the dollar and look at what's been happening against the Japanese yen this week. And it may not be just about that FOMC meeting. And we finish up with the fact that Bitcoin has had a bit of a terrible month in April and what's going on there. So let's start with the FTSE, the UK 100, and London is calling with the stocks on the UK 100 flying high. What a couple of weeks it's been for the UK 100 or the FTSE index. Monday saw the market open at 81.83, that's 8,183, an intraday high of 8,213, a low of 8,152, and it actually closed 81.63. So it was down slightly on the day, but a pretty positive intraday scenario. Back in 2021, whilst not that long ago, if you're looking at a calendar, it seems eons ago when considering the changes in global economies and markets that we've had just in the past couple of years alone. Back in 2021, the FTSE pushed back over the 7,000 mark for the first time in over a year. Now, obviously, this was a time when lots and lots of things were going on globally. Over in the US, we experienced dynamics in the market that hadn't really been seen before, such as the meme stock frenzy and the listing of SPACs, these small companies coming up with huge valuations out of nowhere. At the same time, the FTSE's long-established grey suit bricks and mortar entities with supposed institutional stability rallied despite being almost the opposite of the disruptors of the Nasdaq, for example. So completely different and yet a similar sort of outcome. And the UK was obviously also coming out of a period of lockdowns amidst talk of recessions, obviously the start of rising inflation and a cost of living crisis. Now, 3 years later, we find ourselves above the much lauded 8,000 mark. It's taken some time. We've toyed with 8,000, or certainly there's been an awful lot of speculation about how 8,000 in the meantime, but it was never really sustained. And as we approached that sort of level over the past couple of years, it fell back to the mid to high 7,000s on quite a few occasions. The same Monday, the index hit an intraday high of 8,213, with hopes that this rally would continue. And what were the drivers behind it? Well, individual stocks doing pretty well. Anglo-American stocks are up over 2%, for example, reaching 2,707 pence, or £27.07 per share, following the recent dismissal of a £31 billion acquisition offer. So obviously a lot of attention being paid to that stock. What's their strategy going to be moving forwards after dismissing such a significant offer? On top of that, we had Phaser Group, which is a very large retailer in the UK, also up 2% there or thereabouts at around 815 pence a stock, or £8.15p per share. And Deutsche Bank, in fact, issued a buy recommendation for Phaser Group with a target price of £10 a share. So another one of the sort of old school retailers doing particularly well. I think it's fair to say that enthusiasm for blue chip stocks seems to be the order of the day, giving a positive direction to the UK market, despite what is pretty much a stagnant domestic economy, which we've covered an awful lot, and obviously inflation still looming whilst decreasing. We're circa 81.60 at the time of recording, so it's been a fairly steady week, a few ups and downs, a little bit of volatility, but a lot more to come, I think, from the FTSE. Could be an interesting couple of weeks, so don't forget your risk management techniques, and as ever, keep those eyes and ears open. Okay, secondly, let's take a look at the US dollar and what happened with the outcome of the Fed meeting that disappointed investors a little bit by the looks of it. The US dollar is basically declining. So the outcome of the two-day meeting was the rate was unchanged, not a massive surprise. So it's still in that range of, as in the US, they like to quote it, in the range of 5.25 to 5.5%. There were some comments after the meeting, including the Fed intends to lower rates smoothly and gradually. They did also say that the Fed is ready to adjust the direction of the current monetary policy in the event of risks that could hinder the achievement of the Fed's key objectives. Although a lot of people took away from the overall statement that the likelihood of the next move being a rate hike, I should say, has pretty much negated. Judging by the movement of the major currency pairs after the announcements, I think market participants were hoping for some more prompt changes in the policy. The Fed did say that these higher rates could remain for longer than expected. A little bit of a mix and match. So what happened? Well, cable, that's the British pound against the US dollar, held above significant resistance at 1.25000. And then there was the yen movement, which, to be fair, hints at a possibility of hidden intervention by the Bank of Japan, which we'll come on to in the next video. So it wasn't particularly clear, but let's take a closer look at the great British pound against the US dollar, and we'll take a look at the chart, and we see that chart indicates a possibility of an upward correction towards the 1.2620 to 1.2700 range as a bullish engulfing pattern is formed on the weekly time frame. Now, breaking below the recent lows at 1.23 the figure would invalidate this pattern and possibly lead to a resumption of the downward movement towards a range of 1.2100 to 1.2070. So that's worth keeping your eyes on. Of course, there's an awful lot going on in the market. Some factors that are coming up just in the next sort of 24 hours or so could well influence the price. Friday UK morning time, we've got the UK's Purchasing Managers Index, that's the PMI figure coming out, could well have an impact. And also on Friday, we've got US employment data out due Friday afternoon UK time, which, normally, as we're fully aware of now, sort of employment data in the US can have a significant impact on the US dollar and thoughts about monetary policy moving forwards. Again, an interesting time for the dollar, despite rates staying up there. The dollar has certainly been weakening this week. Thirdly, we're going to take a little bit of a closer look at the US dollar versus the Japanese yen and what's been happening there this week. Now, we've already obviously said that following the Fed statement, the dollar showed a little bit of weakness. Again, that rate was unchanged, and according to CNBC during the press conference afterwards, it's almost removed the chance of the rate hike being the next step. And the Fed said they're going to lower smoothly and gradually the interest rate. So I think those fears of a rate hike, which has been talked about a little bit because inflation not calming as we'd hoped, has negated slightly. And we saw that the dollar weakened against the Japanese yen. In fact, it went from 157.5 down to 153.1 on Wednesday evening after that, circa a 2.7% fall. And that happened in less than an hour. So quite a significant move, although it did recover slightly after that. If we go back further into the week, Monday, we saw some yen strength after the rate exceeded 160 yen to the dollar. As per the article on our website from Monday, fell very, very sharply after reaching that 160 mark to 155.5 and below. Now, according to Reuters, they were saying that some traders saw signs of intervention in that type of movement. So did we perhaps see another intervention on Wednesday? Could, the level of 160 yen to the dollar be the Bank of Japan's tolerance level? Official sources have refused to comment on that. So is Tokyo potentially keeping investors in the dark a little bit about their intervention, their current policy? But certainly those sort of significant moves aren't to be balked at, and as reported by the Japan Times, fluctuations of 5 yen per dollar do indicate interventions based on historic evidence. So let's take a look at the chart and see what that shows us. Following Monday's intervention, assuming that is what occurred, assuming it was an intervention, the price rebounded from the lower boundary of the ascending channel that you can see in black there. So it did recover a little bit. In fact, the rebound peak of around 158 acted as resistance, so that could be coming into play, that 158 level as well. After Wednesday's weakness, the dollar rate, it broke below the previous week's minimum, falling below the median line of the blue channel, slightly longer term channel that we can see there. Now, although the EMA 50 is above the EMA 100, I think a change in market sentiment can be assumed. And that would obviously be evidenced by the price consolidating below the short term channel, which we're showing in black, which may well open the way to the longer term blue channel's lower boundary. Intervention is being spoken about. We don't know for sure unless it's confirmed, obviously, but that could come into play. So it could be quite volatile. So don't forget your risk management techniques. And it could also be, just for a bit of fun, quite an interesting market to follow over the next few weeks. Okay, I'm going to finish up this week. We're going to take a look at Bitcoin market. There's been some pretty significant news on that over the last few weeks. Now, it's worth remembering that cryptocurrency CFDs aren't available in all jurisdictions, and in certain jurisdictions such as UK and Australia, only available to those clients classified as professional clients. So what's been happening? Well, April has basically been the worst month for the Bitcoin USD price since November 2022. Back in November 2022, led predominantly by the collapse of the FTX exchange, which I'm sure we all remember, Bitcoin price fell by 16.2%. In April 2024, Bitcoin's down 14.77%. And the main drive for this is almost paradoxical in that the main event was the halving. Now, that occurs every 4 years and is generally considered to be a bullish factor, as it signifies a slight reduction in supply from miners. So were the expectations from the halving too optimistic? The old adage of buy the rumour, sell the fact could well be employed here. Sort of a bit of a good example, shall we say. Let's take a look at the chart and see what that shows us. And to be honest with you, it is a bit of a mixed picture. If you're looking for sort of bullish signals, well, the Bitcoin USD price is still within the ascending channel, which started back in the autumn of 2023. And the lower border of that channel may well provide some significant support. In fact, point C that you can see on the chart, roughly in that area, is the 50% correction level of the impulse A to B. So it's located around the same sort of level, which could be important. Bearish signals say, well, the price tried to pass a psychological level of $70,000 per coin 3 times. We can see that with the arrows on the chart, but each one was unsuccessful. The price has dropped into the lower half of the ascending channel below that median line, again normally considered to be a bearish indicator. And the price has also fallen below the $60,000 psychological level, and certainly we're seeing psychological levels be quite key elements in cryptocurrency markets. Fundamental analysis also comes into play in that despite the Bitcoin ETF launching in January of this year and the halving in April, the overall price does seem to be down. So we perhaps need the market to find reasons for optimism, and if not, it may attempt to break the lower boundary of the ascending channel that we see in blue. So a lot of hype about the halving in the run-up to April. Halving's taken place, Bitcoin not reacting in the way a lot of people expected. Cryptocurrencies are highly volatile and very, very high risk. So if you are classified and able to trade them, don't forget your risk management techniques. We wish you luck with your trading in the week ahead. Bye for now.